Hello, everyone, and welcome to today's presentation. I'm glad you could join us. Today, we'll be exploring an important topic, free cash flow, or FCF. Our focus will be on looking beyond just profits to understand what truly drives financial health. We'll discuss why savvy investors prioritize cash generation over reported earnings, and how cash really is king in assessing a company's stability and market protection. This presentation aims to shed light on why this often overlooked metric can be so powerful in making smarter investment decisions. So, without further ado, let's dive into understanding why free cash flow is a key indicator in the world of investing. So, what exactly is free cash flow, or FCF? Well, it's essentially the cash that a company has available after it has paid for its essential expenses. This includes the day-to-day operational costs, like salaries, rent, and utilities, as well as capital expenditures. Those are the investments in property, plant, and equipment that keep the business running and growing. It's also the money needed to maintain the current asset base, ensuring the company can continue its operations smoothly. To put it simply, FCF gives us a clear picture of how much cash is truly available for other uses, like paying dividends, reducing debt, or funding new growth opportunities. The formula for calculating free cash flow is quite straightforward. It's the operating cash flow minus capital expenditures. Now, why is FCF so important in financial analysis? Well, unlike some accounting measures that rely on accruals and estimates, FCF shows us the actual cash generated by the business. This makes it a more reliable indicator of financial health. It helps us understand the company's true financial standing, especially when assessing its ability to withstand financial difficulties. Furthermore, free cash flow reveals the company's capacity to handle financial distress because it reflects real cash on hand. It also signals growth potential, since the available cash can be reinvested into the business or returned to shareholders through dividends or buybacks. So, in the bigger picture, FCF is a crucial metric that connects operational efficiency with strategic financial planning. Why reported profits are not enough is a critical point to understand when evaluating a company's true financial health. The problem with reported profits lies in their reliance on accrual accounting, which can sometimes be misleading. Accrual accounting includes non-cash items like depreciation and amortization, which reduce reported net income but don't actually impact cash flow. This leads us to the concept of a profitability illusion. A company might look profitable on paper, but if those earnings don't turn into actual cash, the business could face serious liquidity challenges down the line. So, what's the solution? We need to look beyond just profits. The key is focusing on free cash flow, or FCF. FCF bridges the gap between what the company reports as profit and its real ability to generate cash. By analyzing FCF, investors can get a clearer picture of whether a company can sustain itself without relying on external financing. Remember, reported profits can include non-cash items and recognize revenue when earned rather than when collected, which can sometimes overstate the true financial health. In contrast, free cash flow measures the actual cash generated by the business, reflecting the cash available after all expenses. This provides a much more accurate picture of a company's financial stability and sustainability. Cash is king, and that's a fundamental truth in business. Even if a company reports strong profits on paper, it doesn't always mean the cash is flowing freely. This brings us to the paradox we often see. Businesses can show impressive reported profits, but still face cash flow difficulties. So, why does this happen? Well, net income includes non-cash items like depreciation, which reduces taxable income but doesn't actually involve real cash leaving the business. Additionally, a lot of cash can be tied up in accounts receivable, those unpaid invoices, or in inventory that hasn't yet been sold. These are real assets, but they don't translate into readily available cash when you need it. That's why, despite showing profits, a business might struggle with cash flow issues. Understanding why actual cash generation matters is crucial. Think about operational expenses, paying suppliers and employees. These are immediate cash needs that keep the business running day to day. Then there are debt obligations, meeting lender requirements and paying interest or principal. These are fixed commitments that can't wait. And don't forget growth opportunities. Having cash on hand allows a business to fund expansion, invest in new projects, or pay dividends to shareholders. So, no matter how promising the profits look, it's the actual cash flow that determines whether a business can sustain its operations and grow successfully. Let's explore the indicator of financial health through free cash flow, or FCF. When a company shows positive FCF, it's a strong sign that the business is healthy. Consistently generating positive cash flow means the company has enough cash to cover its operations and investments, and still has surplus cash left over for strategic purposes. This surplus can be reinvested to fuel growth, such as funding new projects or research and development. It also provides options to reward shareholders, for example through dividends or stock buybacks. Additionally, positive FCF allows a company to reduce its debt, strengthening its balance sheet, or to build cash reserves, creating a financial cushion for future uncertainties. On the other hand, persistent negative FCF can be a red flag. It might indicate operational issues or an unsustainable business model, unless the negative cash flow is part of a deliberate growth strategy. Warning signs include ongoing cash outflows despite stable or increasing revenue, high capital expenditures relative to revenue, or rising debt levels. It's important to distinguish between temporary and chronic negative FCF. Temporary negative FCF often occurs in startups or companies making heavy investments to grow quickly and can be strategic. However, if a mature company consistently reports negative FCF without a clear growth plan, it could point to deeper operational problems. Understanding these nuances helps us better assess a company's financial health and its strategic direction. Let's talk about protection during economic downturns. Companies with strong free cash flow, or FCF, have a significant advantage because they can take strategic actions when others are struggling just to stay afloat. So, how does FCF provide financial resilience? First, it means a lower reliance on debt. When a company generates solid internal cash flow, it doesn't need to borrow as much, which is especially important during recessions when financing can become more expensive and harder to secure. Next is financial flexibility. Having a healthy cash reserve acts like a cushion. It helps absorb shocks like lower sales or delayed payments from customers, so the company can keep paying its essential expenses without panic. Then there are strategic opportunities. Economic downturns often create unique chances, like acquiring competitors or assets at discounted prices. And that's where companies with strong FCF really shine. They're in a position to seize these opportunities while others are struggling to stay afloat. Finally, focusing on FCF also benefits investor value. Companies that generate high cash flow tend to be more resilient during market corrections, showing less volatility compared to the broader market indexes. In essence, free cash flow acts as a cushion against economic challenges, providing stability, flexibility, and opportunities that can help a company not only survive, but potentially come out stronger on the other side. Now, let's look at how to calculate free cash flow, or FCF, which is a key indicator of a company's financial health. The basic formula for FCF is quite straightforward. FCF equals operating cash flow minus capital expenditures. Think of operating cash flow as the cash a company generates from its core operations, while capital expenditures are the money spent on assets like property, plant, and equipment. Subtracting CapEx from operating cash flow gives us the cash available for growth, debt repayment, or dividends. But there are also alternative ways to calculate FCF, especially useful when you want to analyze from different angles. One method starts with net income. Here, you add back non-cash charges, like depreciation, subtract increases in working capital, and then subtract capital expenditures. This approach helps you see how net income translates into actual cash flow. Another way is from EBIT, or earnings before interest and taxes. In this case, you take EBIT multiply it by 1 minus the tax rate to get the after-tax operating profit, then add back depreciation, and subtract both capital expenditures and changes in working capital. It's a more detailed view focusing on operating earnings. Similarly, if you prefer using EBITDA, earnings before interest, taxes, depreciation, and amortization, the calculation is similar. EBITDA times 1 minus tax rate, plus depreciation, minus capex, minus working capital changes. This method is useful when you want to focus on cash generated before accounting for depreciation and amortization. Now, where do you find these components? Operating cash flow, or OCF, is found in the statement of cash flows under cash flow from operating activities. Capital expenditures, often called capex, are also in the statement of cash flows, typically listed under cash flow from investing activities, and described as purchases of property, plant, and equipment. To make this concrete, imagine a company with $100 million in operating cash flow and $40 million in capital expenditures. Its FCF would be $60 million. This simple example shows how much cash is truly available for strategic decisions after reinvesting in the business. Understanding these formulas and components is vital because they help us evaluate a company's ability to generate cash, fund growth, and create value for shareholders. Now, let's look beyond just revenue and explore its limitations. It's important to understand that a company can report impressive sales figures but still face liquidity problems. This is because revenue accounting recognizes revenue when it's earned, not when the cash actually comes in. So, you might see high sales numbers, but that doesn't necessarily mean there's enough cash on hand. What really matters is the cash flow reality, showing the actual cash generated after all expenses. This is the true measure of a company's financial health because, at the end of the day, without cash, a business can't sustain itself, fund growth, or meet its obligations to shareholders and creditors. The key takeaway here is focusing on free cash flow, FCF, because it tells us whether a business has enough cash to grow and survive long-term. Remember, what you see on paper, like high revenue growth or profitability, can be misleading if it doesn't translate into actual cash. On the flip side, what you might not see easily is cash starvation, which often results from cash being tied up in receivables and inventory. So, always look beyond the numbers and focus on the real cash flow picture to get a true sense of financial health. Let's talk about free cash flow, or FCF, which is one of the most powerful investment metrics out there, yet it's often overlooked. FCF essentially shows us a company's ability to operate independently, grow in a sustainable way, and protect our investments over the long term. When a company has positive FCF, it means it can fund its day-to-day operations without needing to rely on external financing. This operational independence is a strong sign of financial health. FCF also plays a key role in sustainable growth. It allows a company to reinvest in new opportunities, whether that's expanding into new markets, developing new products, without diminishing shareholder value. Another crucial aspect is investment protection. A strong cash flow acts like a financial cushion during market volatility or economic downturns, helping the company weather tough times without risking its stability. And of course, surplus cash provides the means to return value to shareholders through dividends or share buybacks, which directly benefits investors like us. Having a healthy cash position also gives a company greater financial flexibility, meaning it can adapt quickly, navigate challenges, and seize new opportunities as they arise. So remember, don't just focus on profits alone. Always verify the cash flow. Without solid cash flow, long-term sustainable success becomes very difficult to achieve.